Testing 1, 2, 3. Thank you. Hi, good morning. I'm calling the regular meeting of the Equity Public and Private Committee meeting to order. Today being Wednesday, November 8th, 2023. It is 8 a.m.
I will do an announcement.
Madam
Yes.
Secretary.
Just Madam. Thank you, Mr. Santos. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Santos.
Here.
1 second. Mr. Jones.
Present.
Mrs. Jones.
Present.
Mr. Rue.
Present.
Mrs. Sanchez.
Present.
Mr. Knox.
Good morning, I'm here.
Okay, Mr. Green, Mr. Kelly, and Mr. Jason Green are not here yet. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, CEO Santos Cramen, Deputy CEO Louis Lugo, Chief Counsel Stephen Rice. Investment staff include John Grable and Christopher Wagner. Consultants presenting today are the Stepstone Group. Trustees, please use the raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
Great, thank you very much, Linda. We do have a quorum. Next item will be approval of the minutes for March 8th, 2023.
So
We'll
moved.
entertain a motion.
Move to approve.
1 second. Okay.
We do have a second?
No, we don't have a second yet, Ms. Jones.
Okay, thank you.
Ms. Jones, David Drew. Okay. Mr. Santos?
Yes.
Mr. Jones?
Yes.
Mrs. Jones?
Yes.
Mr. Rue?
Yes.
Okay, the motion passes unanimously.
Great, thank you. Next item is public comment. No requests. We're going to section 4, reports. Private equity, Mr. Wagner, Mr. Fernandez, and Ms. Walker. Good morning.
Good morning, Mr. Chairman and members of the committee and other board members in attendance. For today's committee meeting, your private equity consultant Stepstone will provide a brief overview of the private equity marketplace, followed by a more extensive review of the performance of the portfolio. Now, many of the charts you'll see in today's performance part of the presentation are the same charts that you see every quarter in the portfolio performance book of the total fund. However, you get the benefit of Natalie and Jose's commentary today. So please feel free to ask questions. They'll take you through the charts and do a nice presentation, I'm sure. So if there's any questions for me or for Natalie or Jose before we start, if not, we'll just turn it right over to them and get the presentation going.
Thank you.
Okay. Natalie and Jose.
Ms.
Great. Well, it's good to be here this morning, and thank you for having us. As Chris mentioned, we will provide a brief market overview, and then I'll turn it over to Jose to give some commentary on the performance of the plan. I think just in terms of kicking it off, though, you keep in mind private equity long-term asset class, so built to withstand short-term market fluctuations and movements. Obviously have seen that over the last 12 months. And so really feel like the portfolio is positioned well to withstand the current market and potential future changes to that market environment. If you turn to slide 1, we'll start here just in terms of going over the quarterly returns. So here you can see on the slide, yep, thank you. The quarterly returns for the past 12 months, dating back to Q3 of 2022. You can see largely the private equity market has come out of much of the volatility that we experienced in the first half and Q3 of 2022. And really over the last 3 quarters has shown progress and positive performance, starting with Q4 of last year on the total level. The best performing strategy has been buyout investments. You can see kind of the negative performance of venture capital over the last several quarters as valuations have come down. And we expect to continue to see that over the next couple quarters as valuations catch up to public markets. Growth equity has been positive the last 2 quarters. In total, the quarter for Q2 2023 was a positive performance of 1.6%, slightly down than last quarter. And as you can see, best performing quarter strategy was buyout at 2.4%. Slide, please. So we track fundraising over time, and you can see in this chart just kind of the long-term step up over the last 10 years of fundraising activity, really starting 2013, coming out of the GFC, continued momentum with really the top of the market occurring in 2021, coming out of COVID. So significant capital has been raised, leading to pretty significant dry powder sitting on today. But importantly, that dry powder is getting used up. Markets are down, investment activity is down, but not down as much as fundraising. So you can see in the first and second quarter, fundraising is weighted towards the US. It's also weighted towards buyout investments. In the bars, you can see total dollars raised, both annually as well as the last 2 quarters. And then the blue line, the number of funds raised over those time periods.
I have a question.
Go ahead.
I have a question maybe for Chris. What is our level of dry powder right now in terms of what we have to be able to kind of allocate to managers? This is a really, really challenging time, so I can imagine it has to be an interesting time for us to be able to put money to work.
Yes, the amount of undrawn capital right now is, I think it's a little over $2 billion, between $2 and $3 billion of undrawn within our portfolio.
Got it.
5 billion.
5 billion?
Yeah. The unfunded committed. No, sorry, 2 billion. Yeah.
It's between 2 and 3 billion.
Got it. So that's $2 billion that we have allocated to managers, but the managers themselves have not pulled the trigger on investments.
Correct.
Got it. What about our dry powder to make investments to new GPs?
This year, we have, I'm thinking, we've probably brought to the board, and when you include co-investments in a secondary, we've probably committed a little over between $1 billion and $1.5 billion. Mm-hmm. Our goal when we started the year was around $3 billion based on the percentage that we gave you in the structure review. So we're about half, maybe less than half of where we thought we would be.
Interesting.
But the market is what the market is, and we are where we are.
Got it. Thanks.
And just to follow up on Ms. Sanchez's question, so what is the total dry powder in the industry?
Across the industry, it's about $1 trillion.
The $1 trillion. And why is that significant for us to know and the implications that we have for a program?
Yeah, so dry powder reflects, as mentioned, capital that has been raised but not yet invested. And so that's capital that needs to be absorbed by the system in addition to new capital commitments that are being raised to date. We do think there's enough opportunity, but it's going to take more time. So if you look at like the last 5 years, the average pace at which funds were putting capital to work was about 3 years. Private equity funds typically have an investment period of 5 to 6 years. So essentially they were investing twice as fast as their investment periods allowed. We think that going forward, they'll require the full investment period to kind of put that $1 trillion to work. So a significant amount of supply overhang, but we do think that that comes with a number of opportunities, both on the secondary side, as well as different segments of the market, whether it's deep value, which has seen less fundraising, smaller mid-market, which has seen less growth in terms of just dry powder over time. It's about 5% CAGR compared to double-digit CAGRs up market. So I think it's just going to depend where we choose our spots kind of going forward, because there is a significant amount of capital kind of sitting up market. But that also means that there's a lot of capital to invest at the lower end of the market. That's going to drive liquidity, which we kind of hit on the next couple slides.
Okay, thank you.
So if you go to slide 3, we talk about IPO activity. So this is really kind of impacts the highest end of the market, as well as venture capital exits. So you can see that the IPO market has largely shut. 2021, again, similar to fundraising, was really kind of the top of the market, where you saw a significant $115 billion of capital raised through initial public offerings across 241 transactions. In 2022, just stark contrast, you only saw 17 IPOs as a means of exit opportunity for private companies. Again, this probably impacts the top of the market, the largest companies that are so large that there's probably not private equity sponsors larger than them to acquire them, which really is their only exit opportunity. So we think the more meaningful chart is on the next slide, on slide 4, which shows M&A activity. So this is mergers and acquisitions, so private to private sponsored transactions at the lower end of the market, as well as sponsored to strategic transactions. Again, activity is down. You'll see that kind of just in distributions across the industry. Distributions have largely dried up over the last 12 months. But we do think that that will improve over the next couple years. If you look at the average age of investments across the private equity industry, it's about 5 years. Around the 5 to 7 year mark is when companies start to think about exiting. So we think there's going to be a wave of exits that are going to happen over the next several quarters.
I have another question. Have you seen a change in the way these M&As are being financed? Is it happening in stock and cash and debt? And how is that different from, let's say, where we were a few years ago?
Great question. So in aggregate, we feel like we're in a much better place than we were kind of post GFC. If you look at the GFC deals or pre-GFC deals, is about 30% equity to debt. Today, we're sitting at probably on average 50 to 50, 1-to-1 debt to equity. So deals in general are better capitalized today than they ever have been before. Interestingly, if you look at the last 2 quarters, equity has been closer to 60%. So what's happening is, private equity sponsors are either using private capital leverage providers instead of bank financing, or 2, they're using equity to fill in the void where debt would have otherwise been.
Interesting. Thanks.
So again, we expect over time distributions and exit activity to pick up, but have seen a meaningful slowdown in the short term. And maybe with that, I'll just turn it over to Jose to give kind of a brief performance overview.
Thanks, Natalie. So if you go to page 5 of the presentations, here it's a little bit of a difficult to read chart. So there are the next pages illustrate all of this information a lot better, but wanted to have one place where you see all of the information. As you know, you have a very mature private equity portfolio. It's very stable. It is doing well, and it allows you to be very selective on new investments going forward. This presentation is as of June 30, 2023, so it's going back 12 months as of June 30, 23, going back to June 30, 22, and it's based on the data provided by your custodian of record, State Street. So we collect that data from them and then provide it to you in this presentation. So I'll just note the current market value, as Chris mentioned at the beginning, $13.6 billion. These are the contributions that the system has made, plus the gains that the portfolio has marked, total that. If you add unfunded contributions of 5 billion, you get to 18.6 billion of total exposure. The next lines, I'll show you on page 7, the contributions, distributions, market value. I think they're better illustrated on that page 7. If you look at that, it shows you, for me, it's more visually appealing. You have contributed since inception of the program in 1986, $21.1 billion. You have made investment gains of $15.4 billion, and that translate into a total value of $36.6 billion since inception of the program. What that is today, I mentioned $13.6 billion is the current net asset value. That's the blue line on the blue part of the line on the right-hand side. And the bottom part of that line, the green part, is the cash actually received by LACERA, distributions that you have received after these funds invest the capital and realize the capital and send back the cash to LACERA is almost $23 billion. So, a lot of times we talk about valuations and are those real, are those paper gains, real gains. This is cash. These are real gains that you have received. And what's notable here, if we just go back to page 5, at the bottom of this chart, you have net DPI, that's distributions to paid in capital. So how much capital you have received back relative to your investment, and it's 1.1 times. So you have received more cash than you have invested. And in addition to that, you have a good amount of gains that are still unrealized. In terms of performance, again, just focus on the bottom of the chart, the net TVM, that's the total value multiple. So that is the existing net asset value of the portfolio, how much it has generated as a multiple of invested capital. As of June 30, 2023, that was 1.7x. It's just down from 1.8x. It's just a slight, I would call that basically flat, but it's down from 1.8 to 1.7x. And the net IRR that you have generated since inception is at 16.3%. Again, a very small difference from 16.5% the year before. So again, just highlighting, since inception, you receive more cash that you have contributed. And you have a very stable portfolio. And this is, despite what has been a somewhat negative investment environment over the last 12 months from this report.
So just to follow up with the previous discussion with the dry powder and looking at a performance at this point, I mean, consistently, we always get around 16%.
Yes.
In the last, 10 years, I think.
Yeah.
But so my question is, so we increased the allocation to private equity. I believe we were at 12%. I went up to 18%.
Yes.
Right, and that was in the past 3 years, 5 years already. Time flies.
With the last asset allocation, we moved it to target to 17.
To 17%, right?
Yes.
So we have been looking at these numbers coupled with the prior discussion. We were able to observe the increase in capital that we put in now without any issues, right? Because the dry powder that we have in our portfolio, it's been typical. I mean, I don't remember a year where, you might correct me if I'm wrong, where we were able to deploy 100% of the goal. I just don't remember that.
That's correct.
Right. So my point is that we've been able to observe the increase in capital without any major issue. Or should we be sorry about it and say we made a mistake? Talk to me about that. You understand my question?
Yeah, no, understood. And I think, we can illustrate that with a slide. Maybe I'll just look at slide 6 quickly, and then we'll go to slide 8 to answer your question. Slide 6, which is related to your question, is long-term performance of the fund. So over 1 year, private equity did not perform well, not just on a relative basis, but really on an absolute basis. 5% return is not good for private equity. But that's a one-year basis, right? And this is, of course, a long-term asset class. So if you look at any of the other periods, 3, 5, 10 years, you can see that the performance has significantly outperformed the index that you have selected, MSCI World Index. So long term, you have very strong performance relative to the private market equivalent. So this is if we had invested the cash in the private markets at the same time that the contributions were made, and if we had sold that index at the same time that the distributions were received. So it's more of an apples to apples comparison. Clearly, you on the long term have had very strong performance. 16% since inception, 22, almost 23% on the 3-year. 5-year 17.9 and 10-year 17.1. But if we go to page 8, this has the returns for each vintage year since inception of the program. And I think this goes to the heart of your question, which is, have we been able to absorb the capital and generate good returns with additional capital allocated to this asset class? You can see the returns here. They have been very strong. Basically, 15% is your lowest return since 2010 for each of these vintage years. So it's been, on an absolute basis, a very good return. The other point is, if you look at what the bottoms are in each of these vintage years, look back to 99, right? Bad year there, 2000. Well, that's right before the dot-com crash, right? So those vintage years, those investments that were made in those years, over the next 4 or 5 years, did not perform well. The same thing happens right before the GFC. If you look at 06, 07, those returns were not good. That means those investments were made at the height of the market, and then they did not perform. We may be at that kind of situation again, right? So this may be a very good time to be investing, because we may have a bad 22, 21, but 23, 24, 25, could show a strong rebound if history is your guide.
Without any moratorium like we did in 2010, Mr. Grape.
Thank you. Good morning, Mr. Chair, trustees. If we can go back to slide 6 for a second, I want to kind of widen the aperture with Jose's answer, in that our private equity program is different today than it was 10, 20, 30 plus years ago, in that if we were to dissect the word private equity and talk about private companies, our exposure is far greater, in that LACERA and other institutional investors are no longer just investing in the equity, but we're investing on the debt side of a lot of these private companies. And so going back to the question from the board chair about dry powder, I would say our dry powder is even greater when you include our commitments on the private capital side, because it's financing the same companies. It's whether we're in the debt or some other aspect of that company. So I'd say it impacts the amount of dry powder and exposure, because that's no longer being funded by banks. And then when you look at, on this slide 6, the 1-year performance, where the net IRR from the equity in these private companies may have been 5.2%, but I don't want to wager, but I believe that the returns, and Jose or Natalie may be able to speak to this because their knowledge may be closer, across the industry of private credit, those returns are probably higher over the last year than 5.2%.
Yeah, the returns are closer to 9% in private debt, right? Which is, you take less risk and you did better, right? On a short-term basis, that is true.
The co-investment piece. But just for the public who's listening, I just got a text message on that. When we were talking about the dry powder that we have in our portfolio here, that money is not just sitting in somebody's mattress, it's actually invested in some liquid vehicle. So the money continues to earn until the money is called for.
Mr. Chair, the portfolio is fully invested. We have an allocation for cash, but the portfolio is always invested, and we rebalance in some ways daily, in some ways monthly, as capital is called down for these investments.
And a lot of that cash, it has to be set aside because of the payment of benefits on a monthly basis.
That's part of the monthly analysis in terms of how much cash we hold at any point in time, and we keep a rolling 90-day cash forecast inclusive of benefits and contributions to private equity vehicles, as well as potential returns that we get from private equity style and other investments.
Thank you. Please proceed, Mr. Fernandez.
Great. So we've gone over page 5 and 6 and 7. So and we just talked about page 8 as well. So if we can go to page 9. So this is diversification by strategy. So if you look at this, it's just year-over-year comparison, 2023 on the left-hand side. You can see not a lot of movement from 23 to 22. The buyout section, which is the largest exposure at 62%, stayed exactly the same from year to year, and a slight change, about 2% change for venture and growth equity, and other is fund of funds, co-investments, other investments. So that's primarily due to valuation movements, as you saw from Natalie's presentation of the market. Venture capital has been coming down over the last 5 quarters in valuation, every quarter. So that explains that small change in the diversification. But buyouts have been a very strong performer over the long term. So we think it's very appropriate that that's where the bulk of the capital is invested. And you'll see if you look at some of the performance on the venture, they have been outperformers in certain cases, but that the venture exposure comes with that volatility that you've experienced over the last 5 quarters for sure. So having a smaller allocation makes sense. So that's the performance there. If you go for page 10 through page 12, just break down every vintage year again and shows you how much you committed each year, how much you have contributed of that commitment, how much you have received in distributions, what the current net asset value is, what the total value is, the total gain or loss. In all cases here is a gain, thankfully, no loss. How much capital remains unfunded, that's the dry powder that we, so you can see it actually by vintage year here. And then the net of all fees, distributions to paid in capital, the multiple of that, and the net total value multiple, and the net IRR. I think the takeaway here is, if you look at through all of these vintage years, you are essentially first and second quartile performance in all years except for 2. One is 1987, so I don't think even Mr. Wagner was here back then, and one is 2016, which is third quartile performance for those two vintage year. 2016, I say, still a chance it moves into the second quartile as well, as those funds should now be fully invested, but in harvesting mode. So, still to be seen what happens with all of these more recent vintage years. But the takeaway again, every vintage year, first or second quartile, except for 2 years since 1986. That's very strong performance. Page 12 gives you the view of what's the performance by strategy. And here's where I said, why the bulk of the commitments in buyout makes sense, in addition to the fact that that is the largest part of the market. So is the funds that raise the most money, where the most capital is allocated industry-wide, is in the buyout space. That is the largest allocation for LACERA as well. And here you see how each of these strategies contributes to the overall 16.3% returns in this section. I just note co-investment performance, which is a more recent strategy that the board approved and that the staff is executing on, even though it's a young portfolio, is producing really strong returns at 18.2%. So accretive to the overall returns of the program. And you can see just across the board, very strong performance, except for special situations, which again is a strategy that's been discontinued and not highlighted for a number of years because of the lower performance that's been exhibited here. So if you flip to page 13, here just shows you manager diversification. This portfolio is really well diversified, so no single manager is more than 5% exposure of the overall private equity portfolio, and that's including the unfunded commitments, the net asset value plus the capital that you still have committed and not funded. So that's very, very well diversified portfolio. There's no concentration in any one manager that would be concerning. In addition, we highlighted some of the top managers here, the top 10 managers, and then the top 5 managers. We just wanted to see, well, what's the performance of by exposure, your largest commitments, what is the performance of those 5 managers? And you can see them listed here, and you can see that all 5 have very strong performance, all 5 above the 16% since inception return. Clear Lake is an outperformer, which has done very well. But they have all done well, and they're all being accretive to your overall net IRR, which shows that you have done a good job of concentrating capital with some of the best managers, which has been the idea. If you're going to make some bigger commitments, that those should be with proven managers that are going to generate great returns, and that's proving out to be true. If you go to page 14, this just talks about cash flow. And I think it goes a little bit to Mr. Santos' question about a dry powder or how is it funded, right? A lot of this portfolio is self-funded, meaning the distributions come back to pay for the contributions. Now, you were cash flow positive for a number of years until 2018, then cash flow negative, meaning there were more contributions than the distributions that you received for 2019 and 2020, and then turned positive again in 2021. Frankly, just slight positive there, but certainly positive. But the last 2 years, 22 and 2023, year to date, have been in the negative category. So you are contributing more capital than the distributions you're receiving. That is driven by what Natalie was describing in terms of the market, the lack of liquidity in the market, no IPOs, and M&A activity not completely making up for the lack of IPOs, and being down overall. So that's the reason that cash flows have been negative the last couple of years. We do expect that to continue for the next couple quarters at least, because we don't see that liquidity environment improving in any material way in the next couple months. So that's the things that staff considers in terms of how they invest the capital, because they will need to have some liquidity to satisfy capital calls. It's not all going to come from their portfolio over the next couple months. Now, because it is a very mature portfolio, when liquidity comes back in the market, we would certainly expect that this will be cash flow positive again. And at the bottom of the page, you just see some of the largest contributions and distributions that were received over the 12-month period until June 30th. That concludes our presentation. We're happy to take any questions.
Yeah, I don't see any question at this point, but if you can, let's talk about diversification, geographical diversification. In your comments, if you can talk a little bit about China, what opportunities are there, definitely Asia, how we're looking at the market, the private equity market in Asia, as well as all the other emerging markets like Latin America and Africa.
Yeah, I mean, this portfolio is very heavily weighted to US, with the next concentration being Europe, right? So the Latin American exposure is very, very small, and there's some Asian exposure. Going forward in terms of the opportunity set, Asia has changed a lot over the last few years, right? China has become a more difficult place to be comfortable investing because of geopolitical reasons and economic reasons. The domestic economy in China has been challenged as well. So there are challenges in terms of China, and China is obviously the largest market in Asia. Now, a lot of interesting opportunities emerging in Southeast Asia, in India. So those are areas that we continue to look at. We do continue to look at China because it is a very large market and it's got over 1 billion people, and you can't ignore it as an investor. So continue to look, but very cautious about any commitments in that region and what type of commitments, right? Because you have to be careful with certain industries that are more sensitive from a political point of view than others. AI as a good example, and how that's used for military or other purposes. So something we look at, but you continue to see us to be very cautious there. But really looking at some of these emerging opportunities across India and Southeast Asia. Moving to Latin America, it's been a challenging market for private equity. It's been a shallow market. There is not a lot of capital flowing into the region. And that's been especially through the last 2 years. But there are some, I call it sort of the blue chip houses there, or private equity houses, that have historically done well, and we continue to look at those. And I know LACERA is looking at some of those as well. So there are opportunities there. Frankly, the issues with China have brought a lot of opportunities in Mexico and other Latin American countries in terms of nearshoring, supply chains and production, manufacturing. So an area that we continue to look at, but it is a much shallower market than US and Europe and Asia. So there's not as many players, but an area that continues to be investable and we continue to look at closely.
What about Africa?
Yeah, Africa is, if you were ranking all the geographies in terms of private equity investments in different geographies, that comes at the bottom. Again, I mentioned it's a shallower market as well in terms of the number of private equity general partners that are operating in Africa is less than Latin America or any other market. And it's been a developing industry. But we do have a team focused on Africa. We do think there are opportunities. It's a fast-growing continent. It's a young population, and that creates a lot of opportunities, and also a lot of talent in Africa. With new companies around financial technology services and other services. So we continue to look at it. It's been challenging from the returns perspective historically. So you do have to take an approach of how much to weigh that history versus the opportunity going forward. So we're doing that analysis and continue to look at opportunities.
And then you also have the currency issues.
That's across any that includes Europe, right? That includes any developed economy as well. The currency issues, right? When you go outside of your home market, right? Because all your beneficiaries, all your capital is US dollar, you have to convert it. And then you have, currency issues when you convert it back to dollars, which is what you need to pay your beneficiaries. But that's true in Africa, but that's true in any geography outside of the US.
Good, thank you. Any other questions? Well, thank you very much. Appreciate it.
Thank you.
Going back to the regular agenda here. Let me see, where am I?
Items for staff review.
Oh, items for staff review? Thank you. None. And any items for future agenda? Go to the order. We can wait for the board meeting,
BOI.
unless there's something burning on private equity. Okay. All right, good. I will entertain a motion to adjourn.
Motion adjourned.
Thank you. So 9:00.
Great, so we'll begin the meeting of the regular meeting of the Board of Investments at 9 a.m.
Thank you. Good presentation, by the way.